Ladies, I want to thank everyone for joining our event tonight. This is our Business Booster event with Women Lead Technology. We're so excited. We have some amazing ladies that's going to bring you some just a wealth of knowledge and some information to help you with your small businesses. I know a lot of us kind of, struggle when it comes to like your taxes, your bookkeeping, just a variety of different things. So Women Lead Technology is here to help you tonight. We have some amazing ladies. And so what I'm going to do, I'm going to kick it off to Randy Jennings, and she will introduce our panel. Go ahead, Randy.
Thank you, Kelly. I had to find my unmute key there. So thank you for that nice handoff. And thank you to everyone for joining this, our second series in the Business Booster series of talks aimed at enhancing our competitive advantage in the marketplace of ideas, the new marketplace of digital ideas post-COVID world. We're really fortunate tonight to have two really excellent speakers in their field, one in accounting, one in personal finance and investments. And I know we're all looking forward to hearing everything they have to say to us, as it's great information for this time of change and flux that we're all in. I'd like to start out by giving you some of the housekeeping for this afternoon's talk. From a housekeeping perspective, we're going to have, like I just mentioned, two 30-minute presentations, each followed by Q&A. I'd like to ask everyone, if you have any questions as we go through the presentation, please insert them into the chat box, which you can find. It's on the bottom row, right underneath the speaker, right next between participants and share screen. You should see the chat button. Just touch that button and enter in your questions. When each respective speaker is finished, I will read off the questions that are there, which the speaker will then answer. In addition, if each speaker does have some presentation materials that they will be sharing with us tonight, if you wish to receive a copy of those materials, please indicate the same in the chat box, and we will ensure that you get a copy of those materials at the conclusion of the talk tonight. So thank you. Moving on, I would like to start by kicking off the talk with our first speaker, Anne Giffels, who is an accountant. She's the managing director of BDO Digital. And Anne and I went to college together, so I'm not going to say when, but we both went to school in Indiana, so we've known each other for quite a few years, and she's awesome. And by the way of experience as a managing director in the tax performance engineering group, Anne is responsible for assisting clients in developing a high-performing tax department, leveraging technology, people, data, and processes. She's also a certified project manager, so she's got some broad experience in other areas. And Anne has substantial experience with income tax compliance, tax provision and transfer pricing software, identifying leading practices to improve efficiency, and assisting clients with evaluating, selecting, and implementing the best technology tools for the tax department. So Anne is right squarely in the middle of our sweet spot, and we're really looking forward to what she has to say. So Anne, please take it away.
Thanks, Randy. And I'm so excited to be here. I'm going to share my screen and talk about all kinds of different things. There's a lot of information here, and what I wanted to do mostly is just give you this, and then at least start to give you some ideas of things to think about. It is not comprehensive, and anybody starting a business, it's kind of scary. So sorry about this. It's me and technology. Let me stop sharing, and I got the wrong shared thing. You would think, as a technology person, I would have this figured out, but I don't.
We all struggle, Anne.
Yeah, I was on a call earlier today, and it was a large group of people, and we were making bets who would be the first person to talk with the mute button still on. And fortunately, it was almost me, but it wasn't. So I wanted to just put this disclaimer. Again, I'm giving you sort of general information. Everybody's situation is different, and you really do need to talk to somebody that's going to understand your circumstances and what's really important to you, and how to move forward and start your business. So I just kind of want to put that disclaimer in there just in case your circumstances are different. So let me tell you, I know Randy introduced me a little bit. Yes, I'm a managing director at BDO. So I do both tax and technology. I'm a CPA and also certified project manager. So what I do is I work with corporate tax departments. So my clients might be Time Warner, you know, or some of the larger companies that have an internal tax department. So I work with them on how they use technology efficiently, how do they work as effectively as possible, you know, and you know, hopefully, you know, stop having 40 million versions of the same spreadsheet, which unfortunately will happen. So, but at the same time, as a CPA, I also work with smaller individuals, people starting their own business. I actually run my own business for a short period of time. So I'm kind of drawing on a lot of experiences I had when I started this. So for today, I kind of wanted to do two main sections. First is kind of questions, because and friends of mine that know I'm in tax are regularly irritated with me because my answer to any of their tax questions is it depends. And I unfortunately have to say that tonight about some of these things, because depending on what you're going to do with your business, how you're going to start it up, all sorts of different things, the answer to your questions may change. So I kind of wanted to put together three main questions to think about, and we'll talk about each one of those in more detail. And then just some other things to consider. And, you know, our next speaker, we may have a little bit of overlap with some of these other things to consider. But I just wanted to put some bullets out there. I'll talk a lot more about taxes because taxes are great. You know, I do want to, you know, kind of put some other pointers. These were more things that I encountered when I started my own business. So first thing is, are you going to have workers, or is it just going to be you? Once you have workers, there's a whole layer of administrative stuff that happens. There are payroll taxes that you have to think about. There's different reporting, depending on the state you're in. You may have to pay unemployment insurance for those workers. You know, you may want to think about a pension plan. Healthcare is a big thing. You know, there's a whole set of things to think about, because if you're going to have people working for you, you want to attract the best people as much as you can, and you want to, you know, pay them fairly and all that. So, and so I ask this question often is, you know, even if you're going to have just some part-time employees, you still need to think about these things. And one of the biggest questions that come up with small businesses, and where a lot of small businesses sort of run into trouble, is this concept of employees versus contractors. So I'll tell you a little bit about what the primary difference is. You know, an employee gets a W-2. You have, and all of us that have gotten a W-2, you know, you see a number that is what your pay is, and then there's a much smaller number that goes into your, you know, your checking account. And in between those two numbers are all kinds of taxes and withholdings and, you know, things paid and all that stuff. And that's what happens when you have a worker. So and I'll just talk about taxes, because benefits, you know, health insurance and pension are sort of a separate topic, but you have to pay taxes. So you have to withhold their federal and state income taxes. And what that means is that is money that belongs to them, and you're paying into the federal or state government on their behalf. Then you have to pay, you have withholding on Social Security tax and Medicare. The difference with those two is that you are withholding from your employees half of the actual cost. You as an employer have to pay the other half. And that is something that you have to do with employees. So, you know, if there's $100 you're withholding for Social Security taxes, then you have to pay another $100 to the feds. And one of the things when I work with some folks doing their individual returns, or and they're working, or they have some employee, if they're starting a business. Many companies, some new companies, really get into trouble over payroll taxes because, let's say you pay somebody $1,000 and you're withholding $100 of federal and state income taxes. Instead of paying that $100, and then you end up giving the employee $900. Instead of giving that $100 to the state or the feds, you keep it. And if you don't pay it, they'll put you out of business. And it's unfortunate. It happens a lot, especially for startup businesses, because their cash is everything. Getting enough money to run the business is everything. And they think that they'll be able to pay it later. So it's important to understand with employees, you have a lot of responsibilities for them. For contractors, you don't have to do any withholding. You don't have to pay any taxes for them. And what they get at the end of the year is a Form 1099, and you just have one box to fill in saying, here's what I paid them. They generally don't get health care. They generally don't get a pension. So a lot of people might think, oh, great, I'll just have contractors. It's a lot easier on me. They have to pay, anyone that's received a Form 1099 that works for a business, you have to pay that full boat of Social Security taxes. So, and the full boat of Medicare. So if you're an employee, your employer pays half. If you're a contractor, you pay 100% of it. Anyways, a lot of people starting a small business may think, great, I'll just have contractors. Well, the IRS has very specific rules about how people need to be treated, how your workers need to be treated. I only put a couple circumstances here. On the last bullet point, the status is not optional. It's not like somebody you can say, I'm starting my business. I don't have enough money. I'm just going to pay contractors. Because if you have a regular place of business and they come there every day and you tell them what to do, and you give them breaks and all that, they're an employee. It doesn't matter how you want to treat them for tax purposes, they are now an employee. If they can work for other people, so one of the criteria the IRS will give you is, do you direct that person's work, or do you just give them a deliverable and a goal, an end product, and you don't care how they get there? Those are one of the differences they may look for. Contractors can, have multiple clients. That's another thing. So you kind of look at the degree of control you have over those workers will determine whether or not they're an employee or a contractor. So if you are going to have workers, it's just, there's a whole big slide with a lot of text, but there's a lot of stuff to think about if you're going to have workers. The second question is, where's your revenue? What kind of revenue are you going to be getting? Who are your customers, basically? And one of the reasons I wanted to talk about this is because when you're starting up a new business, your cash flow is going to kind of go up and down. And you have to make sure you can weather that you may get, a nice chunk of money in 1 month and get nothing the next month. And until you get, your business going, you get a regular set of customers, you have to think through, how am I going to pay my rent? How am I, pay my mortgage, whatever, while my business is starting up. And I'm sure our, Dana, our next speaker, is going to talk about this a little bit too. But I did want to talk about it a little bit because that was one of the things I experienced when I started my business. Is I'd have these great months, and then I'd have nothing. And you just have to learn how to, manage through that roller coaster. Are you going to? So if you're selling a product, you're going to probably go to the internet. And you'll be receiving orders from all over the place. There's one thing about sales taxes that you may have to pay in different states, but it's also, you may have to end up filing returns in those states. It's a concept they call nexus. And what that means is that if you get revenue, like I'm in Illinois, I'm in Chicago. If I sell into Michigan, Michigan's going to want revenue from me. They're going to say, well, you know, somebody, you got revenue from Michigan. So, you know, here, you person in Illinois, you owe me taxes. The states, as we all know, are really, really in rough shape. They all want revenue. They're going to grab whatever they can. So whenever you start your business and you're in multiple states, there's sales taxes and possibly income taxes in those states. And this is true. Like I was, you know, in my head, I'm thinking, you know, what if you're selling your businesses, selling software services like I did. That's what I did is I had contractors. I contracted with, you know, multiple clients in multiple states, and I was providing software consulting services. Some states are starting to tax services as well as if, you know, you started a business and you're selling t-shirts. Same, they see it the same way. So it's just something to think about is what kind of revenue and where are you going to be getting it from? And again, I just wanted to kind of point that thing out about cash flow. And this is a big question, business formation. And I have a bunch of slides on this. So because I think it's important to kind of give you at least a high level. All kinds of things to think about. I put it in the box over there. You know, what are the reporting requirements? Can you have investors? You know, are you going to expand your business? Do you need to take out a loan? Do you want to take out a loan? There's all kinds of things to think about. And there's pros and cons for the different, I listed out 5 different sort of, you know, most common business structures. And we'll talk about each one of these. So, and the other thing too, and I'm going to do this on the next slide, is I sort of group these into 2 groups. One is I call the flow through group, and then the other is kind of a separate group. And what that means is that you may form a company, but all of the revenue flows through directly to your personal tax return, or whoever, if you have other investors, you know, you split it up, you know, equally amongst all your, you know, your different investors. So what that means is the business itself does not pay taxes. You pay taxes on that. And there's some advantages to that. And so that's why I kind of group these 3: sole proprietor, partnerships, or what we'll call them S corporations. There's a long, complicated tax nerd explanation why S, but in case anybody cares, put it in the chat and I'll send you something. But so these are slightly less complex organizations. As I said in the second bullet, there's only one layer of taxes. The company does not pay. All of the owners or members or whatever they call it, you know, whatever term they use, they pay the taxes on their share. The big thing is the last bullet is liability protection. So, and I'm qualifying this a little bit with partnerships. There's some things you can do in partnerships to limit your liability, but there's no limitation on sole proprietor. So when I had my consulting business, I actually bought insurance, liability insurance, to protect me just in case, heaven forbid, you know, God forbid, one of my clients sued me, which they didn't. But anyways, it's just something to be aware of. If you're sole proprietor, many partnerships, you're not protected in case something goes wrong in the business. S corps were sort of an evolution. They were like the first kind of version of a company that you could have that gave you some liability but still had flow through. And they're a little clunky. S corps, I don't recommend them for most people because you can only have 100 shareholders. They all have to be US companies or US individuals. They can only be individuals. They can't be companies. And there's some really funky reporting about accumulated earnings that I never quite understand. So they exist. They're one of the earlier types of organizations that were set up, you know, allowed by the IRS to give you flow through, but limited liability. The next evolution is on the next. Oh yeah, and partnerships and S corps. Some of the drawbacks. Sorry. If you ever want to go public, they're not recommended because you have to convert to the what I'm going to call next a C corp in order to go public. Partnerships and S corps require more than one investor. You know, if you're just doing this on your own, those aren't really viable for you. So that's what I'm going to talk about next, is what I call separate legal entities. So the next evolution of S Corp was the limited liability corp, or LLC. You'll hear people talk about LLCs a lot. And then the C Corp. So all the big companies on the stock exchange and all that stuff, those are all C corporations. So you get liability protection, unlimited number of investors and type. So you can have a partnership invest in you, whatever, or C Corp. C Corps, if you're going to do international, it's a little bit easier for you because part of this is certain countries have certain requirements on what kind of business you can do to sell in there. If you're going to go public, if you want to go public with your business, and God bless you if you do, you will have to convert any organization you have to a C Corp. So LLCs were just a really flexible, great idea. They can elect to be taxed. They can elect to be taxed as a corporation, a partnership, a sole proprietorship, or an S Corp. So basically, all of these are from the Internal Revenue Service, ultimately from Congress. Congress passes laws saying we want to provide separate tax treatment for these types of companies. So they started with S Corps and they were really clunky, and then they came up with LLCs, and they're really flexible. There's all kinds of things you can do with them except go IPO. So LLC, I have on the drawbacks. Some LLCs are taxed separately. The LLCs that ask to be treated as a corp, a C Corp, they're taxed separately. C Corps are taxed separately. So if you incorporate your business and it has $1 million of revenue, it's going to pay taxes on that $1 million. Then if you say, I want to take some money out, you declare a dividend and you pay yourself a dividend, you're also taxed on that dividend income. So that's that 2-layer of taxation that some people, prefer not to have. And there's no getting around it. That's what you got to do. There's extra, it's a little more complicated to set up a C Corp. And LLCs are pretty easy. But there is some annual filings that you have to do. Again, the third bullet is what I just talked about with dividends paid. For a startup company, there's a little less flexibility with it. I probably would recommend overall an LLC for somebody, but if it, just to kind of shield you from liability, I wouldn't recommend a C Corp for a startup. There's just a lot of overhead with it. So these are some of the things that we may talk about later. Just some other things to think about. Again, I drew this from my own experience. Even if you choose a sole proprietor, you want to register your business. You do kind of a doing business as sort of thing. And I don't know the specific rules on this, and it varies by state. Especially if you want a line of credit for your business or any kind of other financing, the banks are going to want that because it shows that you really mean it. You definitely want to set up separate bank accounts, especially if you're going to have either employees or contractors. No matter what, if you've got somebody working for you, you want a separate bank account than your personal account. It's easier to prepare the tax filings. Crucial. And me as the accounting nerd loves books and records. I will say I ran my business off a spreadsheet, but it was just me. If you start to get workers, if you start getting different vendors that you have to pay or whatever, I would definitely recommend you look into something like QuickBooks. There's a couple others called Wave or Sage. Sage has been around a long time. QuickBooks is probably by far the most common and most popular. It hooks up to your bank account. It does, you can hook it up for your payroll filings. It's just really cool. It takes, obviously as an accounting person, I think it's cool. Somebody starting a business, their minds are wired differently than me. They don't think it's cool, but it is. And that's what you can do is hire a bookkeeper and they'll take care of this stuff for you. And I'm going to finish with my favorite part, but your probably least favorite part is taxes. You will encounter many types of taxes. Income is just like your own 1040. federal and state. As I said before, you may have to file multiple state returns, and there's some complications with that because sometimes, like I'm in Illinois. Let's say I sold some work in Connecticut and I have to pay taxes in Connecticut. I can maybe take a credit in Illinois on the taxes I pay in Connecticut, but it's a more complicated formula. So, you won't necessarily pay double if you're in multiple states, but it just gets complicated. Sales taxes, as I said before, services now are going to get more and more taxed. Payroll. There's a whole bunch of other little things that everybody wants put their fingers in your checking account. Business license fees, annual fees, franchise taxes. There's all kinds of little piddly things. If you are going to set up a business, get a federal ID number, FEIN. It's really easy. I will tell you, and I think I have it at the bottom, is the IRS and states really do have some good resources for setting up small businesses. So go to the IRS and, just type in irs.gov, type in small business, and they'll help you with that stuff. But they have a nice handy online form to get a federal ID number. States, I've often gone out to different states and they have, just different, resources and links on their homepage for small businesses. So you wouldn't think the government isn't there to help you, but they actually are. And then there's, the government has a small business association. There's all kinds of local associations that can help you steer you towards, a bank that may help you, or whatever. So I just threw a lot of stuff at you in a very short period of time. And that's why I wanted to make sure I get you these slides. Again, they're not going to give you an answer for what your business, but things to think about. And then you can find, seek out different resources and find somebody to help you work through the logistics of your business. So if anybody has any questions, I am happy to answer them. And I want to tell you, thank you. Here's my contact info. Happy to answer any questions you may have. And again, thanks for having me. I'm very excited to be here.
Well, Anne, thank you so much. That was great and very on point to a lot of things. We do have a few questions in the chat box, which I can take you through. We got about a half dozen here, and we've got about 10 minutes to cover them off. So I'll just go ahead and get started reading them now. The first question has to do with the employees. So if you have employees and they sign the W-4 at hire, or conversely, if you have contractors who sign I-9s, how long do you have to keep these documents on file and how frequently are they updated?
So the I-9 is a citizenship form, I believe. So I think both employees and contractors have to sign that. I would keep that permanently because if you're ever asked, have you confirmed citizenship, you have to show them that. I would keep that permanently. W-4s, you actually do keep them as long as they're an employee. So W-4s are to sign up for withholding. For those of you that haven't had that before. And what's interesting is you fill one out, your first day of work or your first week. You can actually prepare new W-4s anytime you want, throughout the year. And so one of the things I do, I work with lower income folks and do their tax returns during the winter. And I often work with them to do that because they sometimes have their withholdings, badly set up. But you can file a new W-4. So I think what I would do as an employer, I would keep all W-4s that were filed within that year. But the most recent one, I would keep it until they file a new one.
So it's up to the employee when they change their deductions or
Yeah,
their
right.
Okay. And what is the companion form then that a contractor would sign to the W-4 if not the I-9?
Well, so a W-4, the companion to W-4 for contractors doesn't really exist because it's really about withholding, and you don't withhold taxes for contractors.
So what do they file to say that they're a vendor to the corporation?
If there is a form, W-7, there's something like they have to provide their federal
Right.
ID number.
Right.
I think it's W-7. but I could be wrong about that. Yes, so they do have to sometimes sign that form, and that's mostly to provide their federal ID number to you so you can issue the 1099.
Right, right. Okay, okay. Thank you. Second question, is it true that contractors have to pay taxes quarterly rather than annually on a federal level?
Yes, I would recommend quarterly. Basically, by the time you file your return, let's say April 15th of the next year, you have to have paid 90% of all taxes due to avoid penalty and interest.
Okay,
So quarterly is recommended from a cash flow point of view so that you're not sending out, this big chunk of money. I mean, you could send it in weekly if you want. In fact, like those of us that, on our salary, our taxes are paid every time, we're paid. So it may be every 2 weeks or, twice a month. So you can pay as often as you like. They're more than happy to accept your money, but I would recommend quarterly at least.
okay, great. Thank you. The next question is, and I think you dealt with this one, if you sell products in other states, you may have to file for sales and use tax certification in each state in which you sell products.
Mhm.
Where would you go to get those sales and use tax form on a state-by-state basis? Is that the Secretary of the State or the Department of Revenue, or does it vary by state?
It probably varies by state because they all call it different things. They all have different groups. So what I do, and I did this because I was working with a charity and we were selling t-shirts on Amazon. I went to stateofillinois.gov, stateofconnecticut.gov, and just then kind of maneuvered, to find, because of course they're going to put it right on their front page about paying taxes.
Okay.
And
Okay.
sometimes you had to call them, but they're more than happy to help you out.
Yeah, I've gone down that road myself, and each state website is very different.
Yes, it is.
I thought, hey, I'm smart, I can figure this out. Personally, I would recommend everybody get a good accountant to help them navigate some of these things, because it can bite you. It can bite you in the tail if you don't do it right. And it's virtually impossible to be up to speed on all 50 states worth of Department of Revenue.
Yep.
Okay, we have two questions that are pretty similar. So, and this is regarding FEIN numbers. If you have an FEIN for one business, but now you have a similar business, what is the process for getting another FEIN? I tried and was told already had one.
That's interesting. Now, if you're doing this sort of as a sole proprietorship, because usually you have a different name. I'm just thinking through like why they would reject it, because you may want to have two bank accounts.
Right. If they're both sole proprietorships and they're tied back to the same
person,
owner, that's why.
That could be, and it would happen because the taxpayer is you.
Right.
Those two businesses are not taxpayers. So that could be, but if you had two partnerships or two LLCs, you could absolutely get, two FEINs, but
So
it's probably
the structure of the business.
Yeah.
Okay. All right. And then the other question was, I started out with a sole proprietorship and I'm changing to an LLC. I have been told I need to reapply for another FEIN number. Is this true?
I think so. And again, the reason is the LLC, it now has to file its own tax return. Whereas a sole proprietorship, you just did your own 1040, but now you've got to do either a Form 1120 or a Form 1065, depending on how you elect to be treated.
I thought the phone company had acronyms, man, but the IRS, I bow to their superiority.
I swear to God, you start talking to the international tax people and they speak in code section. They're like 987, A paragraph B subparagraph little I, and they know exactly what they're saying.
And no one else does.
No one else does. And you talk to an international person, within 10 minutes, they're going to give you a code section.
Wow.
Yeah.
That's great. So
yeah, it is crazy. It's totally crazy.
So we have 3 questions left. Concerning contractors, is it okay to treat a paid intern as a contractor, especially if they work remotely, even if you direct much of what you need them to do?
So when I get into this, it's all about risk. And the reason is that if the IRS deems that person an employee, you owe back taxes on them. So it's a matter of, if you can argue the facts, and I would absolutely recommend going to irs.gov and just typing in employee versus contractor. I will say I did that just before when I was preparing this, because I wanted to get something that's slightly succinct. They have a whole bunch of stuff on this. I would say if you're directing their work and they aren't working for multiple people, they're likely an employee. But it's about risk, and are you willing to risk getting caught?
Okay.
I mean, I'm a nerd, so I always do the right thing, but
Yeah, I mean,
not
as
everybody.
always, never always trust your accountant and your doctor, right?
Yeah. And
Good advice is always good to have. We've got one last question, and that is, does an LLC with no employees or contractors need an FEIN?
It would mostly be, the other question you'd ask is, do you want to get a line of credit, or, a loan, or something like that. Because otherwise, if it's what we call a single member LLC, so SM LLC, to give you
Okay.
yet another acronym.
Yep.
If it's a single member LLC and you elect to treat it as a partnership, it's as if it's right on your 1040. I mean, you
Gotcha.
get the liability protection. And so if, so it really is about, are you going to try and borrow money for the business? And you don't want your personal credit to be included in that
Right.
determination.
Okay. It's a liability issue.
Mm-hmm.
All right, Anne. Well, that takes care of all our questions. I want to thank you again for some great information. We had a couple of requests for the S Corp information and some.
Oh no, you want that? I have to dig it up.
Yeah. So thank you for that. And if you would be so good as to stand by, we'll now hand off the next section to our financial advisor, who is Dr. Dana Palma. And Dr. Palma is a financial advisor with Edward Jones. She brings a wealth of knowledge with an EDD in organizational leadership and 20 years of experience in corporate finance. She works with businesses and individuals one-on-one with the support of thousands behind the scenes. She has an established process to determine what's important to her clients and partner for the long term to help them reach their financial goals. Dana is a forward-thinking financial advisor that provides tailored solutions and attentive service to both locally and around the country. Her mission is to become an essential partner to her clients by helping them define and achieve what is most important financially through a collaborative and educational approach. Please give a warm welcome to Dr. Dana Palma. Dana, I'd like to hand over to you.
Great. Well, thank you so much, Randy. And I appreciate Women Lead Technology for inviting me. I'm going to share my screen. Okay. So I think you pretty much said most of the stuff that I would have said about myself. One of the things, just to let everyone know also is, I tell everyone my goal is to be able to have finance being a discussion at the dinner table. Like Anne, I'm a geek when it comes to math and numbers and stuff. I've always loved that as a little kid. And, as I get older, I really have embraced educating my community and just educating everyone else, in this United States. So I'm really excited to be here, and thank you so much for this opportunity. So Anne kind of talked a little bit about business. I'm going to talk more about just investing overall, because even with businesses, you need to understand not only business investing, but also investing on the personal end as well. So I'm just going to kind of give a brief overview of investing in general. So as you know, the world's ever changing. Technology, obviously women in technology, is finding new ways for us to connect, communicate, and live longer. These are exciting times, but they can be a little overwhelming too. There's a wealth of financial information out there, and it's quite a bit of noise, actually. So what I kind of want to do today is to talk about some challenges and opportunities for women when it comes to investing, as well as cut through that financial noise that you kind of hear. So sharing 5 questions that I kind of go over with my clients to help you better connect with your financial goals. And hopefully you'll leave here feeling a little bit better about your financial direction. I'm going to ask a few questions. So play a little game of fact or fiction. So as a part of the discussion today, I'm going to ask 5 questions. The first of these steps, which we'll discuss in more detail in a few minutes, is to evaluate where you are today. In other words, it's difficult to determine your financial goals, a strategy to pursue them, and whether that strategy is achievable if you don't first understand where you are today. With that in mind, here's the first statement. Nearly 60% of working individuals have calculated how much they'll need for retirement. So, either write this down or just think in your head, is this fact or fiction? And I'll go over this after the other statements. Okay, so the next one is, women have a number of unique considerations in determining the effective strategy to work towards their goal. For instance, historically, women have left the workforce for a time to care for young children or aging parents. So here's another fact or fiction statement. Women are about 3 times as likely as men to report they have left a job to care for a family member. Okay, and the next one is nearly 60% of women who will be solely responsible for their finances at some point in their lives. Is that fact or fiction? So let's see, going back to the first statement. So the first question, nearly 60% of working individuals have calculated how much they'll need for retirement. The answer is actually fiction. Less than half of the working individuals, or 38%, have actually calculated how much income you'll need for retirement. If you don't have a well-defined goal, it makes it that much more challenging to work towards it. So that's why I recommend setting what we call SMART goals, which we'll talk about a little bit later. The next one. Number 2, women are 3 times as likely as men to report they have quit a job to care for a family member. This is fact. This may be a challenging dynamic for many families in today's society. However, historically, this time away from the workforce may have resulted in women accumulating less money towards retirement or other financial goals. That's yet another reason why having an effective strategy in place is so important. And then the last one, which I thought was really interesting. So the question, nearly 60% of women will be solely responsible for their finances at some point in their life. This is actually fiction. Actually, the number is between 80 to 90% of women will be solely responsible for their finances. So there's 2 main reasons. Longer life expectancy. On average, women live 5 times longer than men. And divorce. Today, the divorce rate is around 14%, but even more concerning is the rising trend for the so-called gray divorce. This is adults ages 50 and older. The divorce rate has roughly doubled since the 1990s. So these facts and fictions stated to illustrate are just a few important things to consider as we open the conversation today. So one of the reasons some people don't get started putting their financial strategy together is because there's so many things to consider. It can seem overwhelming. If you feel that way, you're not alone. But through our discussion today, we'll talk about the steps that are needed to get you in that direction, in the right direction. So if there's one thing that I can impress upon you today, I want you to remember this important advice. Do not wait until you're forced to take responsibility for your financial future. Putting off thinking about and making decisions about your long-term financial goals is essentially giving up control. This discussion is designed to help you get started. Hopefully you'll walk away with some knowledge that will help you out there, and that even though through the world of financial information can seem very daunting, there are steps that you can cut through the noise. Okay, so I'm going to talk about 5 questions that I kind of talk about with all my clients, and I think it's relevant whether we're talking about finances or just talking about goals in general for everything that you do. So the 5 questions I talk about with my clients is, where are you today? So looking at your financial goals, your financial picture, what does your income look like? What does your liabilities look like, and different things like that? And what are you currently doing today? Where you would like to be. So, everyone has that pie in the sky, where they would like to be, but really making sure that we're looking at it realistic to say, this is where I would like to be 5, 10 years, 20 years from now. And then the biggest question is, can I get there? So one of the things, and which is why you have to start with where you are today, is you don't know where you're going unless you know where you're coming from. So that's why we have the questions of, can I get there? And then developing that strategy of making sure that you're getting there. So how do I get there? So developing that strategy to achieve your goals. And then on an annual basis, for my clients on a financial standpoint, we track how are we doing with achieving those goals. Are we on track? If we're not on track, what do we need to do to get there? But again, in any goal setting, I think these 5 questions are something to definitely use in that. All right, so next I want to talk about, I'm going to keep the 5 questions up there, but next I kind of want to talk about diversifying your income stream. And there is information that can be emailed to you that kind of goes over what I'm going to talk about now. So a key investor question is, will my money last? That's always a question that we all ask. So, one of the things to think about is diversifying the sources of your income, and this can help you make sure that your money lasts. So there's 3 fundamentals that I apply when looking at investing, is making sure you're diversifying, also making sure that you're buying quality, and then keeping it for a long-term perspective. So let's see. So there's 3 types of income to look at. Consider variable income. So looking at variable income is income that's not consistent time after time. It's going to fluctuate. So that might be a certificate of deposit. You're going to have it for a particular time frame. So more of a short-term investment. And then reliable income. So that's more of that long-term income that you'll have that consistency. So kind of looking at that, some of the things to look at, if you're investing is, looking at 6 to 15-year bonds that mature over time. So you have a more of a reliable time frame of when you will hold that. Fixed income investments. Let's see. And then the next thing that sometimes we forget, and again, either working as an individual or as a business owner, is laddering your reliable and variable income. So even going as simple as just saying, if you're purchasing CDs, say you have $15,000 to purchase CDs, instead of putting all your $15,000 in one particular CD, you can ladder it and do a 3-month, a 9-month, a 12-month, and a 24-month, because you don't know when you might need that money over time. So if you do a 3-month, you'll know at least you'll have a certain amount, after that 3 months, and you can either roll that back over into another 3-month CD, take it out and use it, or put it into something else. So that's, the laddering piece that I'm talking about there. All right, so let me go to,
Dana, are our slides advancing? Yeah.
yeah, where they're about to advance now.
Okay, good. Thank you.
I had certain information I was flipping through, so that's why I didn't have slides for that. But it's part of the email that can be sent out to everyone.
Great. Thank you.
No problem. So the rule of 72, I'm quite sure some people might have heard that in passing. You know, you hear it once and it's like, oh, okay, yeah, I'm going to remember that. And then you totally forget about it and then you hear about it again. So the rule of 72 is a general investment rule of thumb that assumes that your investment principal value and the rate of return remaining constant. This is going to help you determine how long it's going to take for your money to double, or what type of rate of return you're going to need in order for your money to double. So in order to determine that, you would divide 72 by your rate of return. So I'll give you an example. If your rate of return, if your rate of return on any type of investment is 4%, if you do 70, if you do 72 divided by 4, you'll get 18. So that means if you have an investment, so if you say if you have $5,000 and you have a rate of return of 4%, it's going to take you 18 years to double that, 5,000 into 10. So that's where the rule of 72 comes in. And then you can even flip it to say, instead of looking at the rate of return, saying how many years do I need to have this money in order for it to double. So it works the same way. So if you know that you have 12 years to reach your goal and you need to double your money during that period, you would look at what my rate of return needs to be. So it would be 72 divided by 12 would give you 6%. So you need to make sure that your investment is bringing a rate of return of 6% in order to double that. All right, so you can kind of see the relationship between investment, return, and then the time. In other words, the earlier you get started, the less dependent you are on specific rates of return in order to achieve what you're trying to achieve. All right, and then so next is talking about the most important thing, that I want to make sure that you leave today is with, don't wait until you're forced to take responsibility for your financial future. So putting off thinking about and making decisions about your long-term financial goals is essential in giving up your control. As you start thinking about your financial goals, again, think about those 5 questions that I asked that will help you link your financial goals. So again, where am I today? In other words, gaining an understanding of your current financial situation, where it's included with budgeting and different things like that. Where would I like to be? Understanding the difference between your values and your goals. Can I get there? Determining if your goals are realistic by using a SMART test. So with the SMART test, it's looking, so SMART. Are my goals specific? Are they measurable? Are they achievable? Are they realistic? And are they time tested? So that's using SMART goals for that. And then number 4, how do I get there? In other words, developing a strategy. You can use these tools to make sure that you're doing systematic investing, whether it's through a retirement plan, employer sponsored retirement plan at work, or any other type of financial goals that you might have. And then how can I stay on track? So making sure that you're regularly reviewing your strategy to stay on track with your goals. So again, thinking of those SMART goals, So I have a few challenges in the next 48 hours, the next week, and 3 months for you. So in the next 48 hours, commit to set aside some time to review your household finances or your business finances. Add a calendar reminder to your phone or mark your calendar to make sure that you make this a priority. During the next week, gather all your financial accounts and statements. This is one thing I definitely recommend. This was something I actually did earlier in the year was, because you never know what's going to happen. So I actually started to make sure I gathered all my financial account and information and statements and put it in one particular area, and then actually telling someone if something were to ever happen to me, this is where all my information is. So that's always a good thing to make sure that you have in one particular place. And then in the next 2 weeks, create a budget, whether it's a monthly budget, individual budget, or looking at your business finances and creating that plan for the new year. And then in the next month, schedule an appointment with a financial advisor, a CPA, just kind of making sure that you're reviewing your goals, making sure that they're realistic, and developing strategies that make sense to you. And then in the next 3 months, put that strategy into action, and then review every year going forward to make sure that you stay on target to meeting your goals. And that is it for me. Let me bring up this. There you go. So that is my information for you right there.
Well, Dana, thank you so much. That was a wealth of information. I just want to say some of the women's specific statistics I could see in the chat room was alarming for a lot of us. That 80% figure particularly, I mean, I had put that down as fact, and to find out that that was fiction made me a little emotional for a minute there. We also appreciate all the actionable tasks. I think both you and Anne have given us a lot of food for thought here, and we really appreciate all the information that you've provided us this afternoon. We do have about a half dozen questions in the chat room, so let me go ahead and get started.
Okay.
First question that we have for you is on cashing out CDs. Is there a fee for cashing out CDs when they mature?
So I would say it kind of all depends on the financial institution it is with. One thing you definitely want to make sure with CDs is when the end date is, because with CDs, it automatically rolls over. So if you say you have a 3-month CD, it will automatically roll over into another 3-month CD if you don't take it out prior to that time frame. But you want to check with your financial institution, and then, with the interest that you're making off of that will be taxable as far as income. So just making sure that you understand, what that potential additional income that you're going to be seeing.
Okay. All right. Thank you. We did have a request for the information on diversification of the income stream, so I will make sure I pass that along to you.
Yes.
The next question that we have in the chat box is regarding IRAs. Do you recommend them?
So there's 2 different types of IRAs. There's a traditional IRA and there is a Roth IRA. With a traditional IRA, normally, I don't recommend, okay, I do and I don't. Let's say it this way. So if you are putting money towards an employer-sponsored retirement plan, then I don't recommend opening up a traditional IRA unless you left that company and you want to roll it over. So that's one option. With the Roth IRA, I do recommend opening that regardless of as long as you're within that income amount, because the Roth IRA, that's an individual retirement plan for yourself. So that's apart from what you're doing with your employer. And so that I do recommend always, to open up as well, if you're within a certain income range.
Okay, thank you. Next question. In your opinion, is Social Security something you think we will be able to count on for a portion of our retirement income? Or should we plan as if it will not be there by the time many of us are ready to retire?
So with Social Security, when I do my financial planning, I do add it in there to show if you receive Social Security, this is based on your current salary, looking at a 10-year average. This is what you potentially might see. But I also want that individual to know, because unfortunately most people, which I had the question previously, is most people don't quite understand what they need once they retire. I was actually talking to someone earlier, and a lot of people I speak to, the magic numbers, oh, you need $1 million to retire, and you'll be set. Well, that might not necessarily be true. Number one, it depends on when you plan on retiring. That's the first thing that I talk to all my clients about is when would you like to retire aside from today? Everyone says, well, I want to retire when I'm 50. Okay, you want to retire when you're 50? We're going to plan out for your life expectancy to age 90, which means you need 40 years of income. And that's very eye-opening for a lot of people. Unless they, plan to expire before age 90, I always plan out to age 90. So when you start to then put years to that, to say, even at 65, you need 25 years of income, and what is that? What does your retirement lifestyle look like? So that's another question. So I do add Social Security in, but I try not to make it a big thing that you depend on Social Security, because that's not going to cover majority of, your lifestyle.
Right. So it's gravy.
Yes.
Gravy. Okay. We do have a follow-on question on the IRA question. That is, why do you recommend opening the Roth IRA versus not opening the traditional?
So again, if you're working for an employer and you're already putting to an employer plan, that's going to be tax deferred. So to open up a traditional IRA when you're already getting the tax deferred from the employer plan, you might not be able to get a tax deduction with the traditional. So that's why I encourage a Roth IRA, because one of the great things with the Roth IRA is you can choose, working with me, you can choose whatever types of investments you would like. So for instance, for my Roth IRA, I have it in stocks and I also have it in some mutual funds.
Okay. All right. So we have two questions left. One is, one's a pretty big question. Do you want to save the big question for last, or do you want to take the big question now? We're at 8:03.
We could save that for last then.
Okay. So the next question then is a 401k a good investment?
It's a retirement plan. Any retirement plan is a good investment, I would say, as long as you can put money towards it. If your employer is matching, I definitely say try to at least put enough money in to get your employer's match. If you can't, work up towards that, because what they're matching, I'd look at that as that's free money that you're giving away if you're not at least putting enough money in to get that match.
Right. Okay, and the last question, and I know this is kind of a big question and it's highly individualized, but we've talked a lot of great information about understanding our own individual financial goals and how to achieve them. Mm-hmm. The next question is, how do we correct our goals for risk? I mean, obviously we don't have a crystal ball. We have no idea whether we're going to have a catastrophic illness or the stock market's going to crash or there's going to be a tsunami, and we also can't kind of live our lives like that. But what are some tools that you use to kind of adjust your individual goals and leave yourself some fat, let's call it, in the event of an unanticipated change of events that dips into your savings plan?
So a couple things that I talk about with my client, and that was a loaded question. Thank you for leaving that for last. So let's see. Oh, so talking about risk, the first thing I talk about with my clients is actually their comfort level with risk. So I talk about, inflation, what is, and making sure that they even understand the things that I'm talking about too. So, what does inflation look like? And what's their comfort level with inflation of if they want to at least keep pace with inflation, if they want their investments to exceed inflation. And then I also talk about, every so often the stock market will drop 25% in a year. Let's not talk about 2020 because that was an anomaly with 35%, but there are years where the stock market will drop 25%.
Mm-hmm.
So, that's another question that I ask, individuals and business owners is what is your comfort level when your investment drops 25%? Are you going to jump and get out? Are you going to just say, you know what, we have a long-term strategy, let's work towards this? Are you going to invest even more money, because the stock market is quote unquote on sale? So those are some questions and everyone's different. So those are some questions that I kind of go over as far as looking at your comfort level with the risk as far as market changes. Another way to protect yourself is creating a 3 to 6 month emergency fund, where it's not so much that you're investing in, stocks and different things like that, but you have that 3 to 6 month emergency fund because you never know what's going to happen.
Liquidity.
So that's another way to protect yourself. And then definitely a third and final way is life insurance. Making sure that you have life insurance and making sure that you have enough life insurance. A lot of times, depending on your age and depending on if you have dependents, you can have term life insurance and you can have permanent life insurance. With term life insurance, it's a lot cheaper. So most people go to that, but then they realize, well, I'm close to 65 and now I'm not going to have any more insurance. So those are some things that I talk about with my clients as well, is just making sure that you're also insured for the long run, whether it's for you or for your loved ones if something were to happen to you.
Okay. Well, this has been a lot of great information and clearly necessary information for this crowd. And I want to say, and I know I speak on behalf of all the women leading technology when I say thank you so much to Anne Giffels and Dr. Dana Palma for all of the information that you shared with us this afternoon. This has been great stuff. I will be sending an email around with a request for documentation because we did have a few. And Kelly, we've got about 7 minutes left, so I will turn the microphone back over to you for some final thoughts and closeout.
Well, first of all, I want to thank you all once again for this amazing series. This was so thought-provoking. A lot of things you didn't even think about, like, oh, wow, and I mean, that statistic was like alarming alone. I'm like, oh my God, but this was a great series. I'm sure that a lot of us actually learned a lot from this information. Both of you ladies were absolutely amazing, very thought-provoking. And I mean, thank you, Randy, for bringing these ladies over to Women Leading Technology and offering us such a great series of great information. But once again, thank you guys for joining. Tiffany, we want to take a nice little picture at this, at the end. So let's take a nice little snapshot. Let me know you're ready. Perfect. Thank you, ladies. I appreciate each and every one.
Thank you so much for having me and introducing me to this wonderful group. I'm very happy. So
that's
thanks.
Awesome. That's great. So we will make sure that you all get a copy of this. This was taped, so we will get the recording over to you all so that you can post it out, and we will also share it on our social media so that other individuals will be able to have an opportunity to review it, and they will reach out to you if they have any questions and all that good stuff.
Thank you so much. And I do advising all throughout the United States and Canada. So I'm not just in one particular location.
That's awesome. That's awesome. I love it. I love it. Well, thank you, ladies, again for joining and taking the time today. And you all have a fantastic evening.
Thanks all. Take
Thank
care.
you, you too.
Well,
Bye-bye.